I'm going to call first on Craig Lord from Canadian Press, followed by Mark Rendell of the Globe and Mail and Pramit Mukherjee from Thomson Reuters. So, Craig, please go ahead.
Good morning, governors. Thank you for taking our questions. One of the things you mentioned in your opening statement is that since the April MPR, you have growing confidence that the economy is working its way through these headwinds. What is giving you that confidence right now?
Since our last report in April, there have been quite a number of economic indicators, and certainly what they're suggesting is that the economy is now expanding, and the signs as that data have come in have become clearer. For the second quarter, we're estimating growth of about 2.5%. So where is that coming from? Well, a few sources. First of all, we've seen continued resilience on behalf of Canadian households, consumers. Consumer spending has remained pretty solid through this. The housing market had been weak. It had actually been contracting. It looks like it's stabilizing, so it's probably not going to add a lot to growth, but it's not going to be subtracting from growth. I think where we're seeing a bit more momentum is in exports. Exports, as you know, have adjusted to U.S. tariffs, and they now look to be growing again. Yes, they're growing along a lower path than what they were on, but they are getting back to growth. I mean, when we talk to businesses, what we're hearing is they're adapting to this uncertainty. The other thing is that the U.S. economy is strong. That is creating strong foreign demand for our exports. U.S. orders, they are starting to come back. Businesses there's some, in some cases like aluminum, businesses are finding new markets in Europe, for example. So we're seeing a certain adaptation, and with more strength in exports, we think there'll be a pickup in business investment. Certainly, we expect to see some boost in the near term in business investment coming out of the oil and gas sector. High oil prices are encouraging more investment in oil and gas. So, you put those things together. The second quarter is looking. We already have a fair amount of data for the second quarter. That's looking pretty solid. I think the thing that we're going to be assessing going forward is how sustainable is that pickup. We think when we talk to companies, when we look at the sort of change in momentum, we do think it is sustainable. But yes, there is a risk. Growth, particularly exports, could stall. Going forward, if exports stall, I think investment will stall, hiring will slow down. So there are some risks, but increasingly the economy is looking like it is in expansion.
All right, next we're going to go to Mark from the Globe and Mail. Go ahead, please, Mark.
Thank you for taking the question, Governor. In your statement, you removed the reference to potential consecutive hikes if oil prices feed through into inflation. What was the decision to remove that reference? And if oil prices do once again rise, are you expecting to need consecutive rate hikes to keep inflation under control?
The short answer to that question is yes. But let me emphasize a couple things. If you go back to our April report, we outlined a scenario where oil prices were high and they stayed high. And what we indicated is in that scenario, if that happens, the likelihood that higher oil prices start to pass through to prices of other goods and services, inflation becomes more generalized and starts to become more persistent. And we indicated in that scenario, yes, we would likely need at least consecutive hikes in interest rates to get inflation back to our target. So where are we today? Well, today oil prices are lower than their peaks in April. Obviously, in the last week, you've seen them back up considerably. They're about halfway back to where they were. And look, I mean, let's be frank, the situation in the Middle East remains very volatile. It looks like it's a long way from being resolved. And so, yes, if oil prices go higher and they remain higher, there may well still be a need for consecutive hikes. I do want to stress, though, that that's not our base case. It wasn't our base case in April. It's not our base case now. Our base case now is that oil prices will gradually ease. Inflation in Canada will also gradually ease. But it is a risk. And then the last thing I would just underline is it's not the only risk. For example, in my response to the previous question, we are more encouraged that growth is picking up. But there are questions about how sustainable that pickup is, and if that, if exports stall, if investment weakens again, if housing slows, there'll be more excess supply in the economy, more downward pressure on inflation. So there are risks on both sides, and where we landed today is that at this moment our best judgment is where we are now looks appropriate, but we underlined uncertainty is high, and we're prepared to adjust monetary policy as needed.
Okay, next up is Promit. Go ahead, please.
Hi, Governor. The bank now says that the growth has resumed and is broadening, while headline inflation is above 3%, but is easing. Now, how has the balance of risks shifted since April? And as a result of that, where is the bar for a cut and a hike?
Well, you described our outlook pretty well. I'm not sure how much more I can add, really. Look, I'm not going to give you, I'm not going to handicap the next decision. We're going to take our decisions one at a time. I think what I would emphasize there is monetary policy has been facing this dilemma, as you suggested. Inflation is high. It's above our target. It's actually a little bit outside the 1 to 3 band. Growth's been weak. The economy hasn't really shrunk over the last year, but it hasn't grown either. And there's considerable excess supply in the economy, which means there's room for the economy to grow without creating inflationary pressures. The thing is, you can't at the same time raise rates to lower inflation and lower rates to raise growth. So there's a dilemma. What we're seeing relative to where we were is that if this forecast plays out, that dilemma will be resolving itself. As you said, growth will be picking up, inflation will be coming down. And in that sense, yes, it's a fairly positive outlook. There are risks around that outlook, which I've already talked about. The reality is that the world's an uncertain place, and there's always some uncertainty about just how events will play through, how they will affect the Canadian economy, how quickly it's adapting, how quickly higher costs will get passed through. We'll be watching all those things, and as we've indicated, we're prepared to respond as needed.
Okay, in the next round, I'm going to call first on Paul Vieira from the Wall Street Journal, followed by Najoud Almaliz of Bloomberg and Greg Quinn from Market News. So, Paul, please go ahead.
Good morning, Governor. Your opening statement talked about the role the Canadian dollar's weakness is playing in terms of aiding exports, but you also said that it could increase the cost of imports. How much is the value of the Canadian dollar, or conversely the strength in the U.S. dollar? How much is that playing? How big a role is it playing in your rate policy decisions?
Well, the short answer, Paul, is it's not been a major factor. The Canadian dollar has depreciated about a couple of cents since the last decision. We, as you know, we don't target the Canadian dollar. Flexible exchange rate's an essential part of our monetary policy framework. It allows us to set interest rates in Canada for the needs of the Canadian economy. And I think, as we mentioned in the report, you've seen some widening in yield, government bond yields between Canada and the United States. I think that's weighed a bit on the Canadian dollar. As we highlighted in the report, a weaker Canadian dollar does make our exports a little more competitive. At the same time, it does increase the costs of imports into Canada. We don't forecast the Canadian dollar. We've assumed a 71-cent dollar going forward in our forecast. So, I mean, that effect is about, 2 cents is a pretty small effect in our forecast. The boost to inflation would be pretty small, and the impact on exports would be pretty small. It's not a major consideration in the forecast. But yes, I mean, it is embedded in the forecast.
All right. Next, we'll go to Najud Al-Maliz. Najud?
Hi, Governor. I wanted to ask you about the recent string of major project announcements, particularly related to a pipeline in Alberta. I'm wondering if these announcements are changing your view on the medium-term growth outlook, and does the bank see any evidence of these announcements affecting business confidence?
Go ahead.
Well, I mean, these are major projects that are in, I would characterize them as in the development stage, so they don't show up. It'll take a long time before they show up in the hard economic data. Your question about confidence, I mean, it would be hard to discern any one project's effect on confidence measures from the survey data that we track. But I think what you could say is that the move up in optimism that we have in this outlook is affected overall by confidence, and I think it would be reasonable to think that one of the things contributing to that is some of these larger project announcements.
Okay, next on the list is Greg Quinn from Market News. Go ahead, please, Greg.
Good morning. Governor, the report mentions the risk of inflation broadening kind of maybe escalates the longer the Iran conflict goes on. But, that conflict has been going on since the end of February, and there's been lots of ceasefires and not ceasefires. Hasn't enough time passed by now to have more serious concerns about a flare-up in inflation?
Well, you're certainly right that the war is ongoing, and I certainly cannot predict when it might get resolved. So there are certainly some risks there. With respect to what's happened since the war started about 4.5 months ago, I mean, oil prices initially went up very sharply. They peaked in April, a little over $120 a barrel. They actually then came down quite a bit to about $75 US. Obviously, you've seen in the last week, they've gone back up closer to around $85. So they've backed up quite a bit, although they're still a lot lower than they are in April. And yes, the longer oil prices stay high, the bigger is the risk that begins to spill over into the prices of other goods and services, and inflation starts to broaden. It becomes more generalized, and that would certainly be a signal, a warning sign to us. The sort of the progression is, right now, what you see in the data is that inflation is very concentrated in gasoline. The cause of inflation is very concentrated in gasoline prices. Headline CPI inflation, the latest reading is 3.2%. CPI ex gasoline is only 2.2%, and our measures of core, trim, and median are very close to 2%. So far, it's very concentrated in gasoline prices. We will be assessing very closely the spreading. We expect to see some pass-through of higher oil prices to other prices, and we've built that into our projection. I think in the monetary policy report, we indicate the peak effect is about 0.4 on CPI inflation. In the projection, though, that is being somewhat offset by the fact that the economy is in excess supply. That's putting some downward pressure on prices. So inflation, provided oil prices do come down, eases in Canada. There are risks. Clearly, if oil prices go higher, they stay higher, the likelihood that gets passed on, it broadens, increases. And, there's a progression from broadening to persistence. And yes, if that happens, we may well need to raise interest rates. That's not our base case, but it is a serious risk.
Okay, we've got a couple more rounds to go. Next, I'm going to call on Mackenzie Gray from Global News, followed by Judy Trin of CTV. So, Mackenzie, over to you.
Hi there. In the NPR today, there's 2 references to unsold condos in Vancouver and Toronto. I'm wondering if you can evaluate the risk associated with that and offer any comment you may have on the impact that the government's plans to buy some of those condos in BC could have on those risks that you've outlined.
Well, I mean, I think the condo market, both in British Columbia and in Toronto, is going through a pretty material correction. It's sort of the accumulation of the effects of a big decline in an investor market, change in population growth. That's left behind a bit of an overhang, both in the type of inventory and the price of inventory. It's going to take a while for that to clear out. This is something we watch. It doesn't have a big effect on our monetary policy decisions. It has an overall effect on housing. The governor talked about what we see in the overall housing market. From a financial stability perspective, a correction in one segment of the economy and one segment of the housing market is not a direct threat to financial stability. It has to be quite a bit broader and more persistent for that to spill over into a financial stability risk. The programs that you mentioned, I think the details are still coming out about these programs. It may help sort of ease this material correction that's going on, but that's about the only comment we could make on that.
Okay, and next going to Judy from CTV News.
Hello. Is it possible that you are being overly optimistic? I'm hearing so many caveats in your comments as to the state of the economy. At the same time, your business survey that you put out just a few days ago indicated that business sentiment has deteriorated over the past 3 quarters, or has deteriorated after improving over the past 3 quarters. So I'd like to get a better sense of the reality you show. I'm sorry, I'm having problems expressing myself because the data seems conflicting at many points. So what I'm trying to get at is, do you really think that the economy is going to improve this year and over the next few years, given the constraints that we are feeling and facing right now?
Well, we're calling it as we see it. So yes, our baseline forecast is that the economy is going to improve. There are risks around that, as I've talked about. But to come back to why are we feeling more confident that the economy is expanding once again? Going back to some of the data I outlined at the outset, consumers, you got to give some credit to Canadian consumers. They've been resilient. They are consumer spending is still expanding. It's not a big number. There's very little population growth in the Canadian economy at the moment, so there's not new consumers entering the economy. But Canadian households are still spending. That is supporting growth. Where we've seen weakness, we've seen weakness in the housing market. As I said, we don't expect the housing market to be a big boost to growth going forward, but what we are seeing in the housing market is, after a period of decline, it is stabilizing. So it's not going to be subtracting from growth if that holds. Where we see a little more momentum than we have seen is in exports. Canadian businesses have been adapting to a more difficult trade relationship with the United States. That includes severe tariffs on a number of key sectors in the Canadian economy. It's also created an environment where there's more trade uncertainty. We're a good year into that now. What we're hearing from companies is they are adapting. They're finding ways to work with their clients. They're reconfiguring their supply chains. They're getting on with business. And the other factor is the U.S. economy is strong. I mean, the reality is they need our exports, and you're seeing U.S. businesses increasingly, increase their orders for our Canadian exports. And if you get more exports, with that you'll probably get more business investment. We're already seeing plans in the oil and gas sector for more investment. Obviously, when oil prices are high, the value of our oil exports is higher. Companies are incentive to increase output, and so they're investing. So, when you look at the data we have, when you look at our business surveys, you're right that the overall index isn't very optimistic. But if you look at the subcomponents, you look at what companies are telling you about their plans, you can see more optimism going forward. So that is built into our baseline. And that is our best assessment of the growth path for the Canadian economy. Absolutely, there are risks around that. There could be new developments that momentum we see could stall. That is something we're watching very closely. We want to see this pick up and grow sustained. The economy's in excess supply. It's got room to grow without causing inflation. We want to see that excess supply absorbed. That's going to be important to getting inflation back to target and keeping it there. So that's something we're going to be watching closely.
Okay, we'll go into the final group now. I'm going to start with Anna Pereira of the Toronto Star, followed by Rob McClister from Mortgage Logic News, and we'll conclude with Max Sato of Mace News. So Anna, please go ahead.
Hi, good morning. So I know that this is not your base case, but I'm hoping you can give an estimate of how high oil prices need to get and for how long until they need to stay there until the impact on inflation does become broad-based.
Well, I'm afraid you're going to be disappointed because I'm not going to put a number on those things. The value of publishing scenarios like we did in the April Monetary Policy Report is they give you a sense of, without putting a precise number on it, they give you a sense of when it really becomes material. So if you go back and you look at that scenario, I can tell you that what's really key is it's not only how high it goes. The key thing is how long it remains high. If it goes up and comes down, inflation's going to go up and come down, and so that's probably not something we'd want to respond to, because if we raise rates, by the time rates feed through to the economy, inflation's already going to be down, and we're going to regret that we raised them. We didn't need to. What's really key is the persistence. If oil prices are higher and they remain high, then that really increases the persistence of inflation. It increases the spreading of higher oil prices to the prices of other goods and services, and we've been very clear that we're not going to let higher oil prices become generalized, persistent inflation. So that is something we'd need to react to. What I can also tell you is we will be watching closely. We're going to be watching oil developments in oil markets very closely. We're also going to be watching very closely how much those spill over to other goods and services, because how much it spills over also depends on the state of the economy. If the economy is weak, if it's got excess supply, companies they're more reluctant to raise prices. They find it very difficult to raise prices. They don't have enough customers already. If they raise prices, they're going to lose more customers. They may decide to absorb more of that. So that's why I can't give you a simple answer with a simple number. It's going to depend on the state of the economy. It's going to depend as much of the persistence is on how high. But that scenario we published in the April Monetary Policy Report does give you a clear indication.
Okay, next, Rob McClister, please go ahead.
Good morning. Housing has barely responded to a 275 basis point cut in the policy rate, and that's despite a purported housing supply shortage. Do you sense that monetary policy might have lost some traction on housing, and how much could that potentially hold you back from tightening rates in the future, other things equal?
Well, I mean, I think there's a number of things affecting housing right now, Rob. As you would know, monetary policy is one of them, but we have an affordability problem with housing in the country. So, I think that's affecting, dampening the effects that a rate decrease might otherwise have. We also have this overhang of uncertainty. Housing is probably the biggest purchase most people will make, and if you're in a period of uncertainty, your inclination to make that purchase is less. So I think those are things in the mix that are probably holding the housing market back from what would otherwise be a response to monetary policy.
Okay, and finally, Max Sato from Ace News. Please go ahead.
Thank you, Ned. It's been my pleasure working with you. Good morning, Governor. My question is about the monetary policy framework. It seems that 2% inflation target will be unchanged, but in your report on consultations with Canadians released last month, I didn't see a direct reference to the policy decision process in the summary. And while other major central banks have adopted a voting system, can you tell us again why your current process of consensus building works better for Canada, especially from the context of operating in the age of high uncertainty?
Yes. Well, as part of the monetary policy framework review, we're not reconsidering our consensus-based system. Look, we think the consensus-based system works very well, and actually, since we're both part of it, I'm gonna say a few things and ask Senior Deputy Governor to join and give her perspective. But I guess I'd underline a few things. First of all, in the composition of the Governing Council, we do look for diversity of background, diversity of experiences. In recent years, we've added 2 external deputy governors to provide more diversity, to provide additional perspective. What I like about the consensus-based system is that it forces you to really listen to your colleagues. We deliberate. We need to come to a consensus. We need to put our heads together to come to the best collective judgment as what's the best interest rate, what is the best policy decision for Canada. And the consensus-based system, it encourages some back and forth because, I need to try to convince them. They need to try to convince me. I need to listen to their points. They need to listen to mine. And through that process, we come to, I think, a better decision than any one of us would come to individually. We do publish a summary of our deliberations that outlines the options that were on the table. It outlines sort of what the thinking was on the range of thinking was on different issues, and it provides some indication as to how we came to a consensus. So, and I think that the value of that is it gives people a little more insight into what's going on underneath the hood, and I think over time it helps markets understand our reaction function. But you live through this every time I do, so why don't you give your perspective?
Well, Max, I would agree with everything the governor's described. I think we make better decisions in our consensus-based system. I also think the strength is that we communicate with one voice. Getting to our decision requires a consensus, and we also work hard at communicating it in consensus. And so what that means is folks like you have it's easier for you to interpret the decision. You hear only one voice. You're not spending your time trying to parse different messages or determine who agrees with who or who might have dissented or voted differently or anything like that. I think both the decision itself is better and our ability to communicate clearly is better.
And that will conclude today's press conference. So thank you, Governor. Thank you, Senior Deputy Governor. Thanks to everyone for joining us.